Ladies and gentlemen, my name is Mark Hilson. I'm a trustee of the Romspen Mortgage Investment Fund and a director of Romspen Investment Corporation, the fund manager. I would like to welcome everyone this morning to our 2024 annual meeting, and thank you all for coming today. Before we begin, as a courtesy, I would ask that everyone turn off your electronic devices. And before we get started, I'd like to take a few moments to introduce the other trustees. To my left is Wes Reitman. And in the front row, we have Arthur Resnick and Sheldon Esben, the co-founders of Romspen. Thank you. The format for today's meeting will be to first proceed with the formal part of the meeting, following which I will ask Derek Jenkin and Wes Reitman to review the results for 2023, outline our second quarter 2024 performance, provide some insights into future performance, and then to discuss current issues and opportunities. And following that, we will take questions from the audience. Before starting, I need to caveat what we'll discuss today with the obligatory safe harbor statement, which is there to protect both you and the fund. Let me pause on this for a moment, maybe more than a few moments, so you can familiarize with the information on the screen. I would like to thank everyone who attended today's meeting and those who voted by proxy. I will make a few brief introductory remarks, following which Derek Jenkin, a managing partner of the fund's mortgage manager, will review the fund's results for 2023 and its performance through the second quarter of 2024. And then I'll ask Wes to talk about some of the fund's issues and opportunities. A little bit of background about Romspen, particularly for some of those investors who are relatively new to the fund. We, as those kind of investors who've been around for a while, know that we're one of the leading Canadian private commercial mortgage lenders. We try to focus heavily on risk management. Most all of our mortgages are first mortgage security, and we don't use any structural leverage in our fund in order to achieve the returns that we produce. Today we have about 70 employees and consultants across North America, and we manage about $3.1 billion in funds. The fund that we have over the past 16 years has generated an annualized net return to investors of 7.4%. And importantly, the management and employees of Romspen collectively have more than $100 million invested in the fund. So there is a very close alignment between us and our employees and the investors in our fund. Very briefly, an overview of the trustees who essentially oversee the mortgage manager. Sheldon Esben and Arthur Resnick, as many of you know, longtime investors, were the founders of Romspen back in 1966 as an adjunct to the Spencer Romberg law firm. Myself and my partner, Wesley Reitman. In terms of the fund's mandate, this has not changed since inception, is to deliver long-term attractive returns to unit holders. I know in the last couple of years that has been a more difficult challenge, which we know you are not pleased with, and neither are we. The fund has generally been uncorrelated to other major investment asset classes, which is by design. And we've paid strict attention to following our core mortgage investment principles, which have generally produced good returns over the long term. The track record over the long term has been relatively consistent outperformance of other fixed income investments with quite a bit less volatility. In terms of risk mitigation and the investment process itself, as I indicated earlier, virtually all of our mortgages are first mortgages, which are important because that gives us first claim against the security. We obviously, given our size, see a great amount of deal flow, which gives us the opportunity to really try and cherry pick the very best opportunities to put in the fund. And we're a very active manager of the portfolio, particularly, obviously, so when fund or mortgages get into trouble and it requires a lot of heavy lifting on the part of our entire management team. The mortgages that we invest in are typically unconventional and more complex loans that tend to generate higher absolute rates of return. We take a number of steps to provide significant downside protection in addition to being registered as a first lien against the security. And we typically underwrite to a loan-to-value ratio of about 65%, which gives us some headroom in the event that we encounter trouble along the way. And as many of you know, all of our loans are very short-term, typically in the 1 to 3 year range. The interest rates that we've lent at for a very long time have typically been in the range of 10 to 12%, which are quite a bit above what's available for investors in traditional fixed income investments. And as I indicated earlier, we avoid any structural leverage in the fund so that we don't have any issues with kind of third-party debt or using low-cost debt in order to achieve the returns that we generate. So with that very high-level overview, let me turn it over to Derek Jenkin, one of the managing partners, to discuss the fund's performance for 2023 and the first half of 2024.
Thank you, Mark. As Mark noted, I'll be reviewing 2023's performance, and because our AGM is taking place quite late in the year, closer to the end of 2024 than the beginning, I'll also review year-to-date performance in the fund. Setting back to 2023, you have to sort of remember back what was happening back in 2023. Inflation was very high. Interest rates were on the move very aggressively. There was essentially a shift in interest rates, a shift that we haven't seen in at least 40 years, arguably the biggest shift in Canadian history. Not surprisingly, that has a number of impacts on a mortgage lender such as RMIF. And it puts us back on defense. And defense is going to be a pretty strong comment that you're going to hear me repeat over and over again during this presentation, because it has been about being on defense for the last few years, because our mandate, although to generate an absolute return, it's also to protect investor principal. So our goal really has been, in a challenging market, to protect your investment in the fund. That was our core mandate during a stressed and difficult market. That being said, very difficult to operate in that market. With interest rates moving, it causes real estate prices to fluctuate. Interest rates go up, real estate prices tend to drop down. And because the impact of interest rate rises were coast to coast and dramatic, it impacted all asset classes in all regions. And even though RMIF is very diversified, the impact was widespread, and essentially the market came to a complete trickle. This made it very difficult for us to manage through this period, and the best thing we could do at this time was to take a defensive stance. And as a result, investors saw for the first time since the inception of the fund a negative return in the portfolio. But key to that negative return is that we didn't really lose anything. It was a very minor negative return at the end of the day, resulting in a net return of minus 0.3% in the fund. Although investors have been accustomed to returns in the 7 to 9% range, historically, this return was well below historical averages and was a point of concern for many investors. That being said, the average lending rate in the portfolio did start to rise during the period of 2023. The reason for this is that interest rates were higher. So the lending rates that we would charge on renewals were in general higher, and as a result, lending rates started to trend upwards, a positive sign for things to come down the road. Our investor capital remains steady at $2.7 billion. This is to say that, once again, we were very good at making sure that we didn't lose the investments that you entrusted us with. Realized losses in 2023, very low and typical for RMIF, only at $4.9 million against the $2.7 billion of investor capital. Once again, our mandate being defensive, protect your investment during a difficult period. Also during this period, we saw owned real estate assets increase. As part of our strategy, when a borrower is unable to fulfill their obligations of one of their mortgages, Romspen has the ability to foreclose and take ownership of these properties in the event that the borrower is unable to get refinanced by a third party, negotiate new terms that are acceptable to Romspen, or sell their asset to pay us back. If they're unable to accomplish any of those three tasks, Romspen, as the first mortgage lender, has the right to secure the property so that we then internally can maximize the value of that property for our investors. The process takes time, and during this difficult market, it's been difficult for us to execute transactions to sell some of these owned assets, but we see tremendous value in these assets, and we're working towards resolving those owned assets, selling them at full value in due course. Over the last 3 years, since 2021, our portfolio has remained stable. It has been, since the pandemic, a challenging environment. First, we had the pandemic, which again is a widespread stress event that caused havoc on our portfolio, and we had to take defensive measures. In 2021 and the first half of 2022, we were able to start a recovery process, and investors saw their yields improving. But at the end of the day, during these periods of high stress, our goal has been to maintain investor capital and preserve it. This chart here would show that we have been relatively successful doing this. Low leverage. One of our risk strategies, as Mark said, we're all about risk management. And part of that is to not use leverage as part of our strategy. Most mortgage funds use leverage more aggressively. 30, 40, 50% can be mortgaged, if not more. For us, we have always taken the view that leverage is not what we want to get involved in when you're a lender. You don't necessarily want to borrow money so you can lend money out at a spread. When interest rates were very low, many investors recommended that we take on more leverage at the lower interest rates in order to be able to lend out at a higher rate and improve our returns. This is a very common practice. It's a practice used by most lenders, but it goes against Romspen's core principles of risk management. We should not be using leverage to fund our loans. We should just be using investor capital. That being said, by having our line of credit, a small line of credit available to us to use for cash management, it's also there to allow us to manage through more stressed markets. And as you can see in 2022, our line of credit was much higher than normal at 9%. Over 2023, part of our objective was to reduce that back down. And the increase of our line of credit really ties back to when interest rates start to move aggressively in the marketplace, which started to occur in Q4 of 2022. Important to note here that with Romspen, we could use up to 35% in leverage. We've always just maintained the view that leverage should not be a big part of our portfolio. And by keeping leverage low during the last few years, especially when interest rates rose, is that we are not incurring a large interest expense related to a large line of credit. So once again, one of the reasons you keep a low line of credit across the board is not to get incentivized to use it when interest rates are low, where you could potentially make a good return on the spread. You want to keep that line of credit low exactly for this reason, so that when interest rates move up, that you're not exposed to have a large line of credit that you have to deal with. And this potentially turns a lender into a forced seller of assets in a down market in order to service the debt they have with a third-party lender. Net asset value. This has been a bit of a shift for us. Usually our net asset value has remained very stable over the years. Seeing a 1% change in NAV was typically what you would see in a given year. At the end of 2023, as was reported earlier, Romspen had to take a markdown, a revaluation of some of its key assets in its portfolio. And as a result, our NAV was reduced to $3.38 at year end. This is roughly a 36-cent drop year over year and represents about a 4% drop in NAV in total. It's important to note that there wasn't losses related to this. This is an accounting write-down based on the value of the properties by our third-party valuation agents and our auditors, KPMG. But our intention is to recover that NAV as best as possible in the years ahead. Unitholder distributions, 34 cents for the year. Once again, being on defense, we had to add to our loan loss reserves. Wes Reitman will talk more about that in a few minutes. But as you can see here, unitholder distributions have steadily been decreasing from 2021. As you can see, in late 2022, we began taking reserves as interest rates started to rise. We aggressively took more reserves in 2023, including due to the markdown at the end of 2023, which resulted in a NAV change, and a reassessment of the distributions over that period of time. Obviously, our goal here at Romspen is to improve our distributions. That is what we're working on. We're looking to get back to normal times. And as we cover in 2020, the next 2 quarters in a few minutes, hopefully you'll start to see that we appear to be at the bottom of this troubling time, and hopefully we'll be on a bit of an upward trajectory going forward. Due to the 34 cents and then the roughly 36 cents of NAV reduction, unitholder net return shows us at minus 0.3% for the year. One of the key things about Romspen is diversification, and this is all about risk management. I've always stated that Romspen is diversified in typically 3 major ways. First, by asset type. We lend to all property types across the map, and we tend to have a fairly diversified portfolio. We then diversified by the size of the mortgages that we lend to. This is to further ensure that we have a mix of larger and smaller mortgages within the portfolio at all given times. We're then further diversified by geography. In a normal stressed environment, having this type of diversified portfolio helps ensure against any local recessions or slowdowns in one region or one asset type across the map. In general, this has been a very stabilizing feature for Romspen. However, when you hit a massive risk event, such as a shift in interest rates or a global pandemic, it can cause that diversification to get lost because all events are impacting all markets all at the same time. And even though we take every measure to diversify and de-risk the fund as best we can, there are certainly some events that are outside of our control to manage and mitigate against. That being said, our portfolio does remain diversified. We do see strength in certain areas over others, and we will continue to adhere to this methodology to make sure the portfolio is well diversified at all times. The last chart on this is by maturity. Usually, Romspen has a very laddered maturity between 1, 2, and 3 year mortgages. As you would see here, the majority of our loans are now in short-term or less than 1 year money. Although this would imply that we should expect to see everyone pay us back within the next 365 days, the reality is that the market is still constrained. And as a result, when a mortgage comes due, the borrower who is owing us the money is in a situation where they would normally go to a bank to get financing to pay us back, but that option is not currently available. They would look to sell their asset in order to pay us back. And that option is a timely process, which many are working on or may need to finish construction in order to do this. In general, we've needed to roll and extend many of our mortgages to help the borrowers get through this difficult time. We've had to work with our borrowers to help them complete their projects so that we can finish the assets up, maximize their value, so that the developer can then sell or secure financing on a fully leased up property and pay us back. This has been the main reason why we have been in a holding pattern. There's been a lack of liquidity in the fund due to the inability of our borrowers to be able to pay us back, essentially. And as a result, we have been in this defensive stance. As this eases, which in time it will, we expect we'll have more of a laddered portfolio of maturities between 1, 2, and 3 years and resume more of a classical liquidity profile at the fund. Due to the stress of the market, most of our investors have been used to Romspen being that steady yellow line in the middle. Very steady performance over decades, very reliable, even in difficult market times. As you can see, both the pandemic and the rate shift had dramatic impacts on the fund and resulted in us having to take a defensive stance for both those events. These are very rare occurrences. Pandemics are not a normal event. Rate shifts are not a normal event. We would see these, even though they were close together in timelines, they are very rare. We do not expect this to be a reoccurring event in the marketplace. Interest rates have stabilized. The market seems to be recovering. We expect in due course that we will resume more of our steady return profile that investors have been accustomed to seeing for decades. Loan performance. This chart here, one of the feedback comments we've received from investors over the last few years is that we weren't providing enough transparency into the holdings that were jamming us up as a fund manager. This year we decided to individually list some of the larger holdings that are typically the topical loans in our portfolio that investors want to hear more about. And Wes Reutman will go into detail on the Woodbine, Atmosphere, and Austin projects in greater detail in a few minutes. But in general, what I can say is that half the portfolio is performing as expected. We now have 16% in owned assets, which we're looking to maximize their value and sell in due course. We have 18% of our loans which are under review for a variety of reasons. But then we have the three main properties, which we believe that once we manage these properties to their conclusion, will be a significant shift from loans that are giving us a challenge back into the performing loan category. At least the majority of it should go back in the performing loan category. And we believe those three properties will be a very big catalyst for Romspin to move back to historical performance levels. For 2024, since this AGM is taking place in late July, we figured it would be useful for us to cover what is transpiring in the markets today and what we're seeing year to date. The stabilization of bank rates have been very helpful for the marketplace. We do believe that we have seen the worst of it and that the market is stabilizing. And we're starting to see that in the marketplace today. We're starting to see rates improve. We're starting to see more transaction in the marketplace. We do feel that, not to get overly optimistic, but we do feel that the worst is behind us and that we're in a phase where, if things progress as they are, that we should start to see the slow march back towards normal activity in the fund and the normal activity in the real estate markets today. That being said, we do anticipate that distributions for this year will remain below average for investors. So far this year, the unit net asset value has actually improved since the end of the last year, up around 6 cents. Distributions are, as you all know, lower than typical, but the return so far this year has been positive. And as you can see from past years, it's still quite low, but we would be looking to get back to how things were prior to the rate shift back in, say, Q2 of 2022, which was post-pandemic during that recovery phase. That's ideally where we'd like to target back towards. And once again, performance year to date, slightly positive, but once again, we are on a defensive stance. And until the market begins to reopen, we will likely underperform our typical benchmarks of the Canadian Short-Term Bond Index and the TSX Equity Index. Property outlook. It's been a moving market. Things continue to evolve and change quarter over quarter. As everyone knows here, with interest rates going up, it means mortgage rates have gone up. So single-family homes have been under a great deal of price pressure as it's becoming more expensive to finance home purchases through a bank. As a result, we've seen single home valuations decline as a result of the higher mortgage rates. We expect this trend to continue, even though there is a signal from the Bank of Canada that interest rates will tend to decline over the next year or two. Multifamily homes. This is still a fairly strong area that we've seen. There is still strong demand in this sector, but it varies by market. Some areas we're definitely seeing a slowdown, but in general, the multifamily marketplace remains quite strong for Romspin. Retail. Retail is an interesting sector. For years, it was badly disrupted by online shopping. A lot of retailers went out of business, and vacancies went up. But retail's been evolving over the last few years. New stores are opening up, hybrid stores are opening up, and we are seeing a slight uptick, if you will, in the retail markets over the last few years. Office remains somewhat still quite constrained. It is a hybrid working environment still, and likely will be for years to come. This gives office space tenants more power, more negotiating power, and be able to secure lower rates for their rentals, for their office space rentals. This will probably put office space under constrained environment for the foreseeable future. Industrial back in 2021 was quite strong, one of our strongest areas in our portfolio, but it has slowed significantly into 2023. We still see areas of growth, but it may have peaked last year. Leisure and entertainment probably is one of the areas where we've seen the most strength in the marketplace. If anyone's been traveling recently, you've seen that hotels are full. There's many shows. People seem to be up and traveling again. Cost of travel is also very expensive. As a result, leisure and entertainment sector has been quite strong, which has been a good sign for us at Romspen. I will now turn the podium over to Wes Roitman to talk about the issues, opportunities, and then begin question and answers.
Well, thanks, Derek. I guess it's another year. Here we are. Very frustrating year, as I've mentioned to a few of out there. We're still here battling through what is, I think, the toughest market that at least I've seen since the 90s here in Toronto. In the States, at least since the great financial crisis of 08. And we have, a fair amount of challenges. It's not easy. You work on selling properties. It takes a long time to work through with buyers the issues. To get them to waive conditions is very difficult. There's often a late-minute retrade, often an uneconomic retrade, and you have to start all over again with another buyer. You have buyers who can't get their money, can't get their financing, so 2 or fewer out of every 10 transactions that you sign up are closing. It's been a grind. We were joking the other day about that happy face over there in the picture, and there's not a lot of happy faces these last few days, and I feel like I have more bags and less sleep and a few more gray hairs as a result of the last few years. But we come here and we fight every day for our investors and ourselves, and that's just what we have to do. These times are tough. You have to persevere, and you have to wake up every morning, it's a new day, and go face those challenges with the attitude that it's going to get better. It doesn't always stay this difficult. So my partners always want me to talk about the challenges that we face. And in the lending business, the challenges are always the loans that cause you, difficulty. Just as a refresher for people who, don't keep this top of mind, we're built to kind of survive this type of disastrous economy. We expect that a significant number of our loans are going to be issues even when we do them. We're wishing we knew which. It's almost impossible to know. But when you have large macro events occur, like we've seen in the last few years with the pandemic and the pandemic hangovers and rate hikes and inflation, supply chain interruptions, et cetera, it's been a very tumultuous few years, and it kicks a lot of borrowers offside. And so we've seen our loans grow and grow and grow in terms of challenging loans. Hopefully seems to be near the end of that, if not the end of that, but we're getting there. And the way we fight our way through this is, as some of the earlier speakers have mentioned, we're first mortgages, we don't use leverage, we try and stay diversified, even though it doesn't always help when you have large macro events. One thing that we've been focusing on more over the last a few years is our workout team and workout group. We have a dedicated team now that we continue to add to. We have Brent, who's sitting back there, helping lead it with my partner, Peter Olbaum. We are essentially vertically integrated. We can build, we can plan, we can zone. The one thing we were kicking around the other day was, maybe we should even have our own brokerage, because it seems like we get so frustrated with the real estate brokers. Quite often, we're finding buyers and introducing buyers to them, more than they're able to do in a tough environment like this. So, we really fight hard on all of these, and it's tough to achieve results in a market like this, but usually that works out. And the important thing to remember when you're structured like this is that you're not a forced seller. So you don't have to sell. There are a lot of stink bids in this market. There's a lot of vultures prowling. We get them all the time. You'll put a property on the market and you'll see price ranges from somewhere near market value to half or even below half market value. So, there is a great deal of opportunism out there. I don't know how that works out often. I think that a lot of people are wasting their time trying to buy stuff that cheaply. There's not a lot of transactions occurring, and maybe that's why. But it's an important ability to be able to hang on. We don't have a bank, or we don't have anybody breathing down our neck saying, you must sell, just take it, take it, take it. On this chart, I show the progression of the challenging loans. It rose quite substantially there in 2020 with the effect of COVID. Ebbed a little bit in 21 as there was that little honeymoon after the interest rate and stimulus kicked in. And then it started rising again as they responded to the inflation they unleashed. Seems to have topped out. I mean, as we scan through the remaining loans in the portfolio that are performing, there are a few that we have on our radar. We keep wondering, how are they still paying? But they seem to keep paying, and I would like to think that, if they've made it this far, they can continue to make it, through this, and hopefully we'll see this as topped out. Derek mentioned this earlier about reserves. So we've aggressively been reserving since COVID. Again, you see that same pattern in 2020, where we doubled reserves, and then it ebbed off a bit and started climbing again, most notably with the big reserve that we took at the end of this year, or 23. The gray bars at the bottom of this chart, those red numbers, represent our realized losses. And our realized losses continue to be very light because we're not selling. I think that there's going to come a time over the next year or two where we'll use these reserves and we'll just sell this stuff. Some of you may remember in the 90s, it was a long climb back. It took a while. We don't want to wait that long. We'll wait until things start to improve, hopefully, a year, maybe 2 years, but at some point, you have to take your medicine. So we'll see. I mean, that's what these reserves are there for. And if we did use them, it wouldn't impact the results in that year because we've already reserved for them in these years. That's the important thing to remember about those. This chart, I think, says a lot about the state of these markets. Liquidity in our portfolio has typically been around a third of the portfolio would roll every year. And that would be close to $1 billion, maybe a little less, 800 million, would roll in a normal environment. And then, through COVID, we saw it decline dramatically at the beginning and then kind of rebound late in 2020 quite dramatically and continue through 2021. You'll remember that's when we, were paying out a lot of redemptions and doing a lot of business. And then in 2022, when the rate hikes started occurring, all this activity stopped. I mean, banks stopped lending, buyers stopped buying. It became incredibly illiquid, running at half or less than half of its typical level. 23 was not really much better, and 24, has been quite anemic, even more anemic, with half a year at only 100 million. So, it's been a real struggle over these years to continue to fund the construction loans and construction projects that we're committed to. There are a number of those. We featured them in this year's annual report. If you look at the pictures, you can see those buildings. Some of them are very large projects. We have to get those projects finished. If we stopped funding those projects, I think we would have a lot worse trouble on our hands. And so this is really what's been compelling us to fight to preserve and enhance our liquidity. In order, we were fighting our way through that, I guess, narrowly. And then we decided, enough of that. We should actually go and put a solution to that. And earlier this year, we did a loan with a firm out of Alberta for some sub debt. They call it sub-ranking, subordinate ranking debt. Use that to pay off the revolver and keep the revolver powder dry, to help us get through the next year or two if we have to, and finish those loans until they mature and pay back. We anticipate that at the longest, it's maybe 2 more years before those projects are done and finished and can be sold. So we have some ways to go on those, but it's at least they are performing. Redemptions is a hot topic among investors. I know everybody would like to get their money back, especially people in RRIFs and people with life issues and things. It's just a virtually impossible thing to do in this environment, absent some other inflows of capital. And we have to, as I said earlier, maintain enough capital to keep the projects going and get the returns back up. We're currently sitting at about 17% requests for redemption. It's about 500 million. Those requests have come in over 22 months. That's nearly 2 years now of redemption requests. And, we have to solve our issues. For the most part, those big loans that Derek mentioned in the pie chart, and perhaps one other, that collectively I've been calling the four horsemen, which I'm about to get to. If we can solve those, I think that goes a long, long way to allowing redemptions to return to normal, allowing us to get money back out on the street at decent returns, and to get this back on track. What we've done is we put these deferrals in place, as you know. We did the runoff pool. The runoff pool is gradually unwinding. It's still a priority for us. We want to get the redemptions done. It's just likely not going to be possible in the near term with this asset mix. And so we're looking at other ways we might be able to do that. It's not easy. There's a lot of complexity involved. Some of these are most likely secondary type transactions where we organize a group of buyer or a group of buyers to offer on units. There's been a fair amount of this kind of activity among other private funds. It tends to produce relatively low, well below market offers, well below net asset value or appraised values. When we've done that in the past, we've had very few investors who want to take it. Maybe this time is different. I don't know. We have had some interest from people who would consider some discounted offers to buy units, but we have. It's hard because I would not want to recommend a sale at those prices. I wouldn't be a seller. If anything, I would be a buyer at the prices that are circulated. So if that is something that people would like to consider, there's a significant because the other thing about it is people want size. They don't want to do a small transaction. They want to do a large transaction. That's where this money comes from. It's generally the bigger vulture type hedge funds. If we do have enough demand at a low price, we could probably put something together. I just don't think with this group of investors we would, but maybe I'm wrong. Barring that, I mean, I think the only answer is patience. I know it's hard to ask for that, but we just, like I say, I mean, we get up every morning, we come in, we fight. We lose a lot of sales these days. We don't make a lot of progress these days, but we fight every day. And that's what we'll do until we get some results. It's the only thing I think we can do. With that, I'm going to talk about, I mean, usually in years past, I used to talk about these files that were completed, and we had the good news at the end of it. Today, these are not, there's no good news yet. These 4 horsemen. 3 of them, I think you will have heard me talk about last year, so I can update you on those. The 4th is a new one, like I say, we call these the 4 horsemen. It's collectively about $1 billion of loans, and if we can resolve these loans, that $1 billion goes an awful long way to renewing everything. This one, Woodbine, I know we get calls, it's been in the newspaper. Last year, we were in the middle of a active court battle to get Ernst & Young appointed as a receiver, and I had to be very careful about what we could say. The receiver application was successful. Ernst & Young was appointed the last year, wrangling the properties down. There was a lot of junk that Chris had in those properties. They looked awful. If you walked in them, they were floor to ceiling, full of this, that, and everything. He was a bit of a pack rat hoarder. He used to buy closeouts. He's known for his business called Closeout King, and he would buy containers full of any and every product you can imagine and store it in shelves and try and sell it. So we had this stuff everywhere. We had to get it all kind of removed and cleaned out. With Woodbine, which is an indoor mall that's obsolete, we had to work on one of the challenges that he had, I guess, in selling it was that he never put forward a viable project to the buyers, to the developer buyers and the developer community. He would try and lie his way through any of those transactions. So we spent a fair amount of time with Arcadis. We put a density and a development plan on the site. We prepared all the reports, the building condition reports and the soil reports and the environmental reports and everything. We put them in a data room and we launched a sales process. We just got the offers, and it was a really lousy market, so we weren't expecting all that much. The timing is terrible. Better times, this would have fetched, I think, a lot of interest. And so we got the last of the offers on Monday. We are evaluating them. I can't say they're great, but we have 2 that we think we can work with. And so we'll be negotiating those probably over the next several weeks. Hopefully something will come together. I'm cautiously optimistic. But like I've said, I mean, it's not been difficult to get contracts signed to sell stuff. It's been difficult to get them closed and to get them closed on terms. And so, we have 2 pieces of collateral in addition, 2 smaller pieces. And, one of those we had under contract for the last 3 or 4 months at $65.4 million. And, at 60-day condition, they do for an extension, they didn't have enough time. And then at the end of the 30-day extension, they tell us, okay, I'll buy it, but 58. And so, what do you say? Like, what do you say to people like that? I mean, this is you say, okay, here you go. I mean, it's far below market. I mean, maybe give them a few bucks off, but that's just, far too aggressive. We had other options that we, turned away in favor of these fellas. So, I mean, this is the kind of frustration that we suffer day in and day out. So this is, again, it's got to go back. It's got to go back on. Start again with the next one. and hope for a better result next time. We have another property where we think, we've been gutting this one out for a while at Rexdale, not far from here, where the bids first came in super low. This is a site where you have 600,000 feet of as of right, air rights, development air rights. And, the bids were coming in the low 20s, and we were like, this is crazy. That's $30 a foot. I don't know. It's a price even below the price people were paying when I started, with Shelley in the 90s. It's just so absurd. So you wait and you wait and you wait, and you eventually they come up, and now we're within spitting range of 30. So we're thinking, yeah, maybe we'll take that just to move on. But it's that kind of thing. It's taken almost a year to fight with the marketplace to get those kind of numbers. And even then, if you sign that up, the odds that it close are negligible. So some of them do close. We have a few that have closed, but it's very frustrating. So that's where we are on Woodbine. The next one here is Atmosphere, and this is one where, if you recall, after our last marketing exercise, the bids were low because people were concerned about the expiry of the building permit. Out in BC, they give you a year to get your construction going, and this borrower had expired that. So we retooled, we rehired the architects and engineers, we lobbied with the city and were successful at, they had changed building codes, so we were successful at grandfathering our project in the old codes, did something called code equivalency, which still required that we re-engineered the building and do new drawings, which we did. That took some time, a crazy amount of time, frankly. But it's done, and we're at the point now where the city of Richmond has signed off, and they're prepared to issue the new building permits. There's a dispute with Richmond over fees. They want more fees, which were paid earlier, and we're arguing about that. But at least the building permit issue is resolved. We are about to engage a broker to put it back on the market, and we'll see what happens. This is a 1 million square feet of development. It's a podium and 7 towers. So you can build the podium in one go. The towers you can do at your leisure, although you'd want to do at least 2 or 3 initially. There were a lot of sales and pre-sales of the retail and the apartments that we can continue to use, but they're actually out of the money now. We think a resale would likely produce a higher result, but it might take a while to do a resale, so we're kind of evaluating that. I think the biggest challenge with this one is the capital required for the construction. We need to find a partner who can come up with the hundreds of millions of dollars of construction money you need to build 1 million square feet. You don't have to build 1 million square feet all at once, but you're going to have to build probably 650, 700 of it at once, and that's a big ticket item, especially with the way construction costs have run up. So our hope here is that we can find a partner. We have had some discussions with large developers who are somewhat interested, but likely we're going to have to stay in and work through the construction of this to an end result. So this might take a little while, but hopefully, knock on wood, we can get our money out, or maybe we get some of our money out initially and wait for the rest. That one seems to be making progress. This one in Austin was conceived. Let's talk about the past. We've been here a number of years through one group of partners, and then that partnership dispute, this is while it was performing, resulted in another set of partners, and then that partnership fell apart, which resulted in a foreclosure and bankruptcy, which we got involved in, with one of the partners disappearing and us continuing with the other partner. And today we're now fighting with that other partner. And the project was always a very exciting project. It always seems to get a lot of interest. It's the old Motorola facility in East Austin. Beautiful piece of land backing onto the river. It was imagined as a high-tech campus. Austin's a tremendous growth market. We had interest from the Googles and the Teslas, and like all these big companies were interested in making it a headquarters or a tech park. But it's tough now in offices. I mean, I think it's going to have to be completely reimagined. Real estate, inner cities, a bunch of things kind of return to normal, but we're not getting the leadership from governments and the large corporations, I think, to affect that. So unless that changes, this is going to have to go back to town council, and we're going to have to try and find other uses. It's 100 and some odd acres. You're not going to make that an office campus, I don't think. So we got to look at either industrial or perhaps some residential uses. Anyway, this one is a challenge. And then the new one, this is a high luxury leisure property in Boca Raton. Some of you may know it. It's not far from Meisner Park, at the corner of Camino Real and the Federal Highway. It is a Mandarin Oriental and a club, spa club, golf course. The golf course is located further inland, Jack Nicklaus course. It's to be a beautiful property and very, very high end. Developer's a very capable guy, but he grossly underestimated the costs. We have him in forbearance at the moment. We've stopped accruing interest because we're uncertain as to the source of funds to complete this project. He's working and has been working for a number of probably years now, maybe a year and a half, at sourcing capital. He has a couple term sheets from large hedge funds who want to work with him on a conversion of the built apartments that you can see in white over there. That's the phase one. They're rental apartments. They want to convert those to condos and unlock some value there, then use that value to complete the hotel. He's just he's taking his time negotiating. I think he's maybe a little more eager to do the sale because it's a very high number, but I don't know if that sale will close. I think the financings are more likely, so it might take a little more persuasiveness by us to get him to do that and get this thing built. In the meantime, we have him in forbearance, and we're working, this is an old picture, we're working on getting the building enclosed at least, so that it'll be tight to the elements. And there's a lot of very high appraisals of this, even for this audit. They're still coming in. Florida's still doing well. The challenge here is we have a borrower who needs a lot of money, and it's not a very liquid environment in which to find it. So we will see how this goes. If we have to take it over, I don't relish that. I would prefer to work with him, but we may have to take this one over as well.